What are the best low correlation asset classes for my portfolio? Imagine trying to keep your investment boat steady in a stormy sea. The secret is having different types of assets that don't all move the same way. When some assets dip, others might stay steady or even rise. That's what low correlation assets do for your portfolio. They help spread out risk so you don't get hit hard if one part of your investments falls. Correlation measures how closely two assets move together. If they move perfectly together, the correlation is 1. If they don't move at all, it's 0. And if they move in opposite directions, it's -1. Low or negative correlation assets tend to move differently from each other, which is good for reducing overall risk. One example is real estate that isn't part of a real estate investment trust. Think of rental homes or farmland. These tend to behave differently from stocks and bonds. They generate income from rent or crops, which can keep your money steady even if the stock market drops. Gold is another asset that often moves independently. When stocks fall or currencies weaken, gold usually holds its value or even increases. It's been a safe haven for centuries and can act as a shield during economic stress. Long-term government bonds, especially those issued by the United States, tend to go up when stocks go down. They act as a cushion, providing steady returns and helping balance your portfolio during market dips. Private credit or lending investments are loans made to companies or individuals that aren't traded on public markets. These usually don't follow stock market trends closely and can bring in regular income. Commodities like oil, agricultural products, or infrastructure investments such as utilities and transportation often respond to different economic factors than stocks and bonds. For example, oil prices might rise even if stock markets are falling. Investing in stocks from other countries, especially in developed or emerging markets outside the United States, can add geographic diversity. These international stocks often don't move exactly with U.S. stocks, helping spread your risk across the globe. Certain financial products like whole life insurance, cash value, or structured notes can also provide low correlation benefits. They offer liquidity and sometimes tax advantages, making them useful for long-term planning. Assets like real estate investment trusts, which are companies that own real estate, can sometimes have a moderate link to stocks. They might not always be the best for diversification if you want very low correlation. Cryptocurrencies have shown low correlation in the past, but recently they've become more connected to stock movements and are very volatile. For adult investors, mixing these low correlation assets can help reduce the ups and downs of your portfolio. It's important to balance risk with your financial goals and how soon you might need your money. Keep in mind that correlations can change over time, so review your investments regularly. Remember, diversifying doesn't eliminate all risk, but it can make your portfolio more resilient during tough times. In the end, including assets like real estate, gold, government bonds, private loans, commodities, and international stocks can create a more stable and balanced investment plan. This approach helps protect your money and supports your long-term financial growth.